Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel, and I see we've just recently ticked over 200 subscribers, so I think we went from 100 to 200 at about half the time that I went from 0 to 100. So I appreciate that. I really want to thank every one of you guys individually for coming along and subscribing to the channel and kind of listening to what I have to say, I suppose. So enjoyed interacting with you guys in the comments and that sort of thing, so keep dropping them down below as always. So what we're going to talk about today is something I don't think we've discussed on the channel before, and that is arbitrage. So typically arbitrage, it comes in many different forms. There's things like merger arbitrage, where a company will make a bid for shares at say $50, and the shares themselves are currently trading at say 45, and you can take advantage by buying at 45 and then having your shares bought out at 50. So that's merger arbitrage. There's other forms of arbitrage like you have with, for example, the Berkshire Hathaway A and B stock, where accounted for, adjusted for the economic interest in the business, because the Berkshire B shares have a much lower proportional ownership than the A shares, and that's why A shares trade at $300,000 or whatever it is, and B shares trade in around the 200s off the top of my head. After accounting for those, often the A shares trade at a slight premium to the B shares in Berkshire Hathaway because they have slightly more voting power, and because you also have the ability to convert those shares to B at any point in time, but the B shareholders can't ever convert back up to A. So typically the A shares trade at a slight premium. What happens occasionally is that the A shares are actually discounted to the B shares, and that gap will almost always be closed by arbitrages. So people that will sell the more expensive B shares at that time, buy the A shares, and that gap will close over time, and they can take advantage of that small sort of percentage difference between those two classes of stock. So those are a couple of different examples of arbitrage, and I've got to give a shout out to Lewis Paz, who actually sent me a recent article about Bill Ackman's fund, Pershing Square. So that's the potential arbitrage opportunity we're going to talk about today, so let's get into the details. So Bill Ackman's fund, Pershing Square, currently trades on both the London Stock Exchange and the Euronext Stock Exchange, and currently the fund is trading at quite a substantial discount to net asset value. So what that means is that all of the shares and businesses that Bill Ackman currently owns in Pershing Square are actually much more valuable than the price that you can currently buy shares at. So you can currently buy shares at a 28% discount to net asset value. And what that means is that if you buy those shares at the current price, and there's no net change in sort of net asset value, and the price is correct back up to their value, you're looking at about a 38 or 39% upside based off the current prices. And that creates a really interesting opportunity for arbitrages. So I want to get into some of the finer details of this opportunity and how you might go about playing this sort of arbitrage opportunity if you would choose to, and also talk through some of the risks and that kind of side of it as well. So full disclosure, this isn't something that I'm doing at the moment, simply because of the fact that I really don't have easy access to those exchanges without a whole bunch of fees. And also we'll get into the risks involved with this kind of trade as well. But it's certainly an interesting sort of case study and an interesting opportunity. And I'm hoping that I'm going to be able to inform you guys so that you can look out for these arbitrage opportunities in future. So the first thing is that closed-end funds typically always trade at a discount to net asset value. If you buy individual companies yourself and you have full control overall the sort of direction of how you manage that money in the future, then that's much more beneficial and you're going to feel much more comfortable than potentially giving your money to someone like Bill Ackman even, or some other closed-end fund manager where you don't really know what moves they're going to make and that sort of thing in the fund. So there's typically always some discount, maybe somewhere in the 5% range has been the typical discount to net asset value for Pershing Square. Currently it's 28%, and Bill Ackman has been quite vocal around the fact that he thinks this fund is significantly undervalued at the moment. And he's putting his money where his mouth is, so Pershing Square have recently released plans to do a $100 million share buyback. So that represents not quite 3% of all the outstanding shares of Pershing Square. So Bill Ackman's on our side with this sort of arbitrage opportunity. He thinks that these shares are undervalued at current prices as well. but I want to talk through a couple more of the risks and things you might want to watch out for before you do go ahead and do this trade if that's something that you choose to do. So risk number one, and I think to understand this well, we've really got to get into the couple of ways that you could potentially approach this opportunity. So the first one and the simplest one is just to buy shares in Pershing Square, and that's about it. And wait for the shares to appreciate to net asset value and for that gap to close from other people taking advantage of arbitrage, from the share buybacks, and from the quite good performance that Bill Ackman's had this year. So his fund is up around 40% this year looking at net asset value. So that's the first way to approach it. The second way to approach it is much more standard in the way that you would typically take advantage of arbitrage opportunities, but it's quite complicated with a closed-end fund like Pershing Square just because of the number of investments. And that is basically you buy Pershing Square and then you short all of the individual holdings that Pershing Square has in the exact proportion that Pershing Square owns it. So you'd be going out and you'd be shorting Chipotle Mexican Grill, you'd be shorting Starbucks, you'd be doing all these different things to basically get the exact opposite positions on in your own sort of portfolio to what Pershing Square owns in their portfolio, and you're essentially trying to close the gap. That's basically the way you would approach it. As I say, it's quite complicated just because of the sheer number of positions, but the other thing that comes along with that is you don't know how long that this discount to net asset value is going to last. If this lasts for a long time and you're shorting a whole bunch of companies that Bill Ackman is long on, for example, you're going to be paying fees the entire time on all those short positions. You're going to be putting some money towards that, and it's going to get quite expensive. And there's a chance that even after all that time, if net asset value the current price does close, you're going to have paid so much in fees that it's not going to be a profitable investment for you. So that's a risk. The other risk from the kind of simple side of doing it is you buy Pershing Square shares, and that's sort of all you do. And the risk with that is that Bill Ackman's investments actually come down to a larger extent than the current discount. So, for example, they're currently trading at a 28% discount. He has a large holding in Chipotle Mexican Grill at the moment. Chipotle has dropped 50% or more fairly regularly in the past, or at least a couple of times in the past. So the risk is that, the actual investments Bill Ackman owns drop more than the discount itself, and you're going to lose money either way. So that's certainly a risk, and that's the reason that you may choose to go with the, inverting the positions that Bill Ackman currently has, and buying Pershing Square and having that gap close. So I thought that was a really interesting case study, and I hope you guys enjoyed that video. If you did, definitely hit like and subscribe and drop some comments down below. As I say, this one's definitely a bit more complicated than your typical arbitrage, but keen to hear if you guys have ever done arbitrage investing or taken advantage of these opportunities. As we're small, kind of nimble investors, we can also take advantage of these arbitrage opportunities, which is quite cool. So, as I say, I hope you enjoyed the video. Hit like, hit subscribe if you did, and I'll see you in the next one. Cheers.